Shaun, when you saw the numbers, I guess I want to start there, just in terms of what you saw, in terms of what it says about the Canadian economy. Give us some context on the jobs data. How strong is it?
Well, it's a very good report, Amanda. I think the market consensus was for a somewhat smaller rise in employment after the big numbers we had in August, over 81,000 jobs in August added as well. So those 2 months combined, plus some of the details of today's numbers. I think under the hood you can probably poke around and find some softness there, but generally higher wages, lower unemployment, hours worked across the economy was up. This is a pretty good report overall, I would say.
So just in terms of, we did obviously see that reaction, and then speculation of what it means for our central bank. What do you think it does suggest about what the bank may or may not do in the months ahead?
Well, our call for some time has been that we would see a rate cut in October. That's predicated on the idea that the bank might need to take out some insurance against some of the headwinds that have been picking up against growth in North America. The trade tensions obviously been a big consideration there. But I think realistically, given what we've seen just over the past couple of days, where on the trade front we seem to be making some progress towards some sort of mini or partial agreement between the US and China. We've had a fairly big concession, it would seem, from the UK today on Brexit, which rather suggests that we're moving away from the cliff edge, at least Brexit risk there. So some of those issues that may have been worrying the bank about the global outlook have dissipated, and the economy realistically here, we're tracking by our estimate at Scotiabank somewhere just under 2% growth at the moment, which is a bit above where the bank thought the economy would be in its last NPR in the third quarter. So those things combined, I think, rather militate against the idea of a rate cut, in fact. And we've seen rate cuts, in fact, when we look out across the curve, pretty much priced out over the next few months in Canada. We're still pricing a little bit of easing in the US by contrast, but markets here in Canada are pretty much sitting on the fence in neutral, in effect, as far as the policy outlook is concerned. So
then, of course, one of the other aspects here would be what we did see in wage growth. We are seeing some wage growth here. How do you think that plays into what the central bank might be thinking about the need to raise rates at some point?
I don't think that's realistically on the cards at this stage, but I think under other circumstances that might have been a subject of discussion. We've seen perhaps some evidence of tightness in the Canadian economy coming through today with that drop in unemployment, or at least less excess capacity is probably a better way of saying it. The tightness in the labour market with the drop in unemployment, wages remaining relatively strong here. It'll be interesting to see what we get in the next week or two with the bank's business outlook survey, and whether that tightness or reduced capacity, if you like, is reflected in the bank surveys. Realistically, rate hikes are just not on the cards at the moment. There's one maybe relatively major central bank globally that's been in tightening mode, but we can see pretty much globally across the world, in Europe, Australia, New Zealand, and of course in the US, that central banks are rather heading the other way. So if anything, it says that the bank is probably going to sit on its hands in effect for longer.
Of course, one of the reasons that we were looking for cuts here and elsewhere is because we had expected a weakness in the economy, including there's lots of talk about recession just a couple of months ago. When you look at this data, what does it suggest to you about recession probability for Canada?
Well, pretty low, but as I say, our tracking at the moment has the economy probably growing somewhere in the region of 1.8, 1.9%. That's a fair bit above, realistically, effectively where the bank thought we'd be in Q3. But our wagon is very much hitched to the US outlook, and I think if we see a continuation of the trade headwinds that we've seen evolve over the last year or so, that is going to slow growth a little bit more, not necessarily towards a recession, but it will have a material impact on growth if those headwinds persist.